Good afternoon, everyone. Thanks for joining us today. We have a presentation by Anaconda Mining. Before we get started, a couple things. As always, this presentation will contain forward-looking statements. If you'd like to know more about those, you can find them on the company's presentation on their website, which I believe has been updated for this session. And there will be an extensive Q&A session, so feel free to put your Q&A in the Q&A box at the bottom. Most people already know the story, so it'll be more of an update. For those that are not so familiar, you can check out some of the previous webinars on the Adelaide Capital YouTube channel. With that all out of the way, I'd like to introduce Kevin Bullock, CEO, and Rob Dufour, CFO of Anaconda Mining. Hi, guys.
Hey, Deb, happy to be here.
Yeah, happy to have you. So since the last time we had an update with you, you put out quite a bit of news, including a PEA on Goldboro. So looking forward to getting into the numbers. Maybe you could start just by providing an overview of the projects that you have in the ongoing drill programs.
Yeah, thanks, Deb. So we're working in Atlantic Canada. As most people know, we're in Newfoundland and Nova Scotia. And we have an operating mine in Newfoundland that produces, for us, significant cash flow that helps in our growth strategy. An exploration project called Tilt Cove, about 40 kilometers east of our assets. And Goldboro, which is our new project, subject to the PEA that you just said, that's really forming the basis of future value for Anaconda Mining. So, you know, we're quite happy to have those. We have drill programs going on at all of those projects. We'll be drilling to the west of the current resources at Goldboro and infill drilling as well. We'll be drilling for new discoveries at Tilt Cove, and we're drilling to extend mine life at the current mine in Newfoundland. And I'll just take you quickly through some of that and spend some time focusing on the PEA. So here's the location of our assets in northern Newfoundland. We are the only permitted gold mill producing gold on the island, which gives us a distinct advantage and leverage to move things forward quite quickly through permitting and into production. Anything around our site can be trucked to site. We've been producing there for over 10 years, have a great infrastructure, including the team of people, and continue to provide free cash flow. It's enabled us to build up quite a robust balance sheet, and we continue with free cash flow that we can put back into the ground like we do to move Goldboro forward, which you see here in Nova Scotia. This is a very advanced project that we keep moving forward. See a picture, an air photo showing it's an industrial area with just stunted growth forest. Great place to be permitting a mine. At our size, as a junior, having such a world-class deposit, we're happy to say that it's 100% ownership, totally unencumbered, no royalties, no streams, no joint ventures, and it's located obviously in a low-risk jurisdiction. And we're up to close to 2 million ounces of measured and indicated resources and 800,000 inferred. However, what we'd like to demonstrate is that it's open in all directions and has a lot of resource growth potential. As we sit now with the resources that we currently have, the PEA that we issued 2 or 3 weeks ago demonstrated a project that could generate an after-tax NPV at a 5% discount of 550 million Canadian and 24.5% IRR. That's at $1,550 US gold. At today's price of gold, it's more like 700 million and a 30% IRR. And it's still subject to an ongoing definitive feasibility study that'll be done by the end of the year. Point Rouge keeps chugging along, and Tilt Cove is our exploration in Newfoundland that's quite exciting as well. Nobody's changed as far as people. We feel that we have the right team. And what I'll do now is hand it over to Rob to just give an update on the corporate structure, as we have carried out a financing since we last spoke.
Yeah, thanks, Kevin. A few things that have changed here. It's just a reminder, everyone, we do trade on the TSX on the big board as well as OTCQX with 174 million shares outstanding. We previously had a very big warrant overhang that we inherited years ago, but that is actually largely cleaned up, and we now only have 5.5 million warrants outstanding, which come off in the next 3 months, and they're all very much in the money. So some inbuilt financing there. What we did, as Kevin alluded to, in May, we completed an $8.5 million flow-through financing that is going to allow us to be very aggressive with the drill bit over the upcoming over the upcoming year. We generate free cash flow from Point Rousse, and that enables us to move things forward, but we are opportunistic where possible, especially with flow through. As some of you may be aware, that enables the company to issue shares at a premium, and so we did that financing at 32%, and the financing we did last year was at 40%. So very opportunistic way to raise funds to be aggressive. And that just complements what's already a strong cash position. We ended the first quarter with 14.5 million. So if you add on the 8.5, and you can kind of do the math there, we will report Q2 within the next week, and it'll show that balance. Also, as part of that financing, we're starting to see tremendous amount of institutional interest. That financing was completely done virtually all with large institutional shareholders out of Europe and North America. And that's also where we think we'll start to see that in our analyst coverage. We do have analyst coverage from two groups, boutique mining firms, but we're starting to see other institutions, particularly large mining institutions that are well known, come into the story, especially with the scale of Goldboro. And that's really what's driving it. So I'll turn it back over to Kevin to chat about how this has evolved into the large deposit that has become now.
Thanks, Rob. We are in an area of southern Nova Scotia referred to as the Maguma terrain, meaning these anticlinal structures whose noses approach surface and limbs go to depth. And we're at the eastern end of the geological trend that's host to the Moose River Consolidated project that St. Barbara acquired from Atlantic Gold for over $800 million Canadian a few years ago. Within this map, there are between 6 and 7 million ounces of gold in 11 deposits. And in our single Goldboro deposit, we're approaching 50% of that total, making it the single largest gold deposit in the Maguma terrain, and also the largest in Nova Scotia. We are also the highest grade undeveloped open pit project in the Maritimes, sitting at 1.1 million ounces of open pittable resources at 2.85 grams in situ. I won't spend much time on here, that they are the resources, and as you can see, the open pit resources measured and indicated make up well over 90% of the resources in the pit, and therefore that whittle constrained pit will not change much from here to feasibility. We've managed to locate all our infrastructure in one single watershed, which is important in Nova Scotia, which is a fishing province. We have a fully lined tailings storage facility designed to handle up to 20 million tons of tailings, and 4 large waste dumps around the open pits, designed to hold the waste that's generated from the open pit mining, and a 4,000 ton a day CIP-CIL hybrid plant that'll produce the gold at a 96.4% recovery, and that is feasibility level recovery. The PEA suggests a combined open pit underground mine, starting with the open pit for 5 years, starting to develop the underground in years 6 and 7, and then mining for a total of over 17 years, generating 550 million discounted NPV at $1,550 gold. The 96.4% gold recovery is feasibility level. That number will not change. It's a great recovery. It's fairly clean ore. And that allowed us to use a 0.46 gram per ton cutoff for the open pits. And so overall, on average, 112,000 ounces per year for almost 18 years from what we know to date. That varies quite a bit in certain stages throughout the production profile, which I'll take you through. The NPV to initial capex, and remember this is Canadian dollars for initial capex, 286 million, which includes 50 million, 50, of contingency. So we can actually move on improving that. But even now, the NPV to initial capital ratio is 2, well over 2 actually at today's price of gold. But what I like most about, what we like most about this project is the unit costs. $668 per ounce cash operating cost, and under 800 for all in. If you look at any senior, mid-tier, or good large junior mining company, that would be considered low-cost mining. So we're very happy to be in the lower quartile for unit costs, which helps the project as well. Rob, do you want to just elaborate a bit on the PEA?
Yeah, and I think worth highlighting here that most of the as Ken mentioned, we're working towards a feasibility study. So a lot of the inputs and assumptions that have been used for the PEA are feasibility level. Not typical. Most PEAs, juniors, there's a lot of leeway. This is very accurate and very real as what we know today. So basically, we realized we're looking at a long-term mine life here. So we used a base case gold price of $1,550 US, in line with consensus, but also, if you look at most, the seniors and the mid-tiers, that's what they carry their reserves at. So I think that's an appropriate basis. Gives us a, Canadian dollar gold price, $2,000, and that's, we've been well above that for a long time now. Life of mine, almost 18 years, but as we'll talk about later, we think this is going to be a multi-generational, multi-decade mine, and we'll show why. And it's quite compelling. Overall strip ratio 6.6. We're processed 4,000 tons per day, and with gold recoveries of 96.4%, and that is feasibility level study work. Nothing to do further there. That's what we'll see in the feasibility study. Average annual gold production over 110,000 ounces per year for almost 18 years, but we'll show you how that changes over time. And again, I think it's worth mentioning on the capital cost, that's an amount, importantly, that's eminently feasible for a company of our size to finance, and for a project this robust in a first world country. We're very confident in our ability to do that. And we have made sure that this is a very realistic plan with sustaining capital costs, the drilling required to convert underground resources, all the development. There's nothing that's been left or assumed away. All those costs are included. And so with that, you get almost $4 billion in gross revenue, $1.6 billion in undiscounted pre-tax net cash flow at a $2,000 Canadian gold price, well over $500 million after tax NPV. But of course, at today's gold prices, it's significantly more valuable than that. On an after-tax basis, over $700 million Canadian. And if we get back to $2,500 gold, where we've been for many periods over the last 18 months, this is approaching $1 billion project. Importantly, though, for a long life project, it's robust the other way as well. Gold could come off, be very volatile. We've seen that. It could come off as low as 1,400 US, still profitable, and it still works as a project. And that's important over time, because the goal here is to proceed to build this. We've put together, Goldboro is now in a very different peer group than we might have put it in before. And I think the groups you see are where we think this needs to be considered. The Osiskos, the Skenas, the Marathons, as this is now a very large project. And in particular, what we like to, to me, the comp that we look at is Marathon Gold's Valentine Lake project, and not just geographically because it's close, but if you look at a lot of the economic parameters, if you compare to what they've put out, and now that's feasibility level study, to be clear, that for Valentine Lake. But if you look at a lot of the key economic metrics, you'll find that Goldboro stacks up very well against that project. And so that's, for us, we think that's the value gap that we need to close as we move forward and continue to de-risk the project. Kevin?
Thank you, Rob. This might look a little complicated to some, but it's simply the ore or the gold produced from open pits in blue and the gold produced from underground in gold. And superimposed on top of that is the cash cost and all-in costs. So you can see we start the first 2 years building, and then we spend 5 years open pit mining, averaging a little over 80,000 ounces a year. And then we start developing the underground with cash flow. And you can see the all-in sustaining cost shoot up in year 6. That's developing ramps from within the open pits at certain bench heights so that we contain noise, dust, visual sightings. And the actual cash cost doesn't rise that much because you're still producing quite a bit of open pit ounces. The year 7, we start developing the sub-levels in ore, which produces ore, and therefore it goes into the operating cash cost, but it's expensive ore because it's level development. So you see both the cash costs and all-in costs, because you're still sinking the ramps, go up considerably. The year after, you then start stoping underground, so mining underground and mining open pit for the next 6 years, where the cost drops significantly. We approach 200,000 ounces a year 1 year, but on average for the next 6 years of open pit and underground, it's 137,000 ounces a year on average at very low all-in costs and operating costs. From year 14 onwards, we're actually just underground mining and adding our low-grade stockpiles that we've collected over time to continue at 4,000 tons a day, producing about 100,000 ounces a year. We don't think it'll play out like this. We think the tail end will not drop off because of the opportunity ahead of us, but certainly for now, what we've drilled to date, which isn't much and open to expansion, gives us quite a long mine life. To look at it a little differently, sustaining CapEx, you can see how it rockets for years 6 and 7 developing the underground, but you can see that the cash flow, after-tax cash flow, approaches zero but doesn't go below. So there is not a secondary financing required for 285 million of sustaining CapEx to develop the underground. So we're really developing the open pit and underground for an initial capital of 285 million. You can see then that the cumulative after-tax cash flow continues through $1 billion undiscounted for the rest of the mine life. So the way it will look, what we call a long section is looking from within the ground to the north. You can see that the west pit goes down 250 meters, the east pit 200, and then we have 4 main portals coming off the pits to mine at depth and in between these. So our development underground goes approximately 450 meters deep. Our deepest drill hole, which hit a very good intersection, is 550 meters deep. And the analogs around the world for these types of deposits go to several kilometers. So there is a lot of upside at depth here where we haven't drilled yet. But more importantly, there's near-term upside near surface. The close to 3 million ounces that we've been talking about are on the eastern half of our concession in the 2 pits that straddle this Goldbrook Lake. And there is a buried natural gas pipeline that limits us from going further west with the western pit to date, but we're able to mine on either side of it, leaving a 60-meter buffer. We have drilled a few holes west of it and are hitting the mineralization. We know that a past producer from the late 1800s to early 1900s, Dolliver Mountain, were mining these Maguma-style systems. And so there's mineralization here, there's mineralization here, there's 1.5 kilometers of ground in between we haven't looked at yet. And that's why we raised the 8.5 million, a part of the reason. More than half of that will go towards geophysics and drilling. Just doing the math, you can actually double the resource based on the spatial area of our concession that we haven't looked at yet. So a lot of upside on strike, a lot of upside at depth and down dip for this particular project. We have delivered the results from the PEA. That was in parallel to a feasibility study. I would like to ensure that everybody understands the feasibility will be based on open pit mining only, as feasibility studies can only use measured and indicated resources, and therefore will look different than the PEA, but it will be a phase 1 feasibility. Because we don't start the underground till year 6, we have time to mine and understand the deposit better as we drill off the inferred resources at depth, to then do the phase 2 feasibility, which is adding the underground component to the overall plan to look like the original PEA. So when that definitive feasibility study for open pit mining only is done by the end of the year, within 6 weeks, we'll be submitting our environmental assessment registration document, very robust document with all of the components in it from the feasibility and some for environmental. And that starts a process for final permits, which is a 6 to 18 month process. We're guiding and assuming 18 months, being only the second mine to be permitted, gold mine to be permitted in Nova Scotia, which would make us shovel ready in mid-2023 for this particular project. So we're quite excited about this. It will be the next gold mine in Nova Scotia, and the economic numbers really look good. We'll touch on Newfoundland for a second, Rob, if you don't mind, and then we'll go to Q&A.
Sounds good. Yeah, as I think probably many of you know, Newfoundland's become quite a hotspot for exploration, and the amount of dollars that have come in is unbelievable. And we think we're pretty well positioned to that end and have very unique advantages relative to some other groups in the area. And one, as we'll touch upon, is our Tilt Cove Gold Project, which is prospectively one of the best out there. And two, and very much related and complementary, is we are the only gold producer on the island and have the infrastructure to leverage to really fast track from a discovery to production. And a great picture, as we've shown before, is our Pine Cove Mill and operation facility. And one of the most valuable things we have is that big hole in the middle, which is an in-pit tailings facility. It's now fully operational, 10 plus years of capacity. Environmentally, nothing better you can do. To do something like this on a standalone basis, yeah, it would cost you $40–50 million, but it would also take you 3 to 4 years, maybe more, of permitting. Those risks to production risks we don't have, and that's an important value proposition. Point Rousse kind of keeps ticking along. You know, we've gone from, we really look at Point Rousse, relatively small production. Last year we did 18,200 ounces, but it's an engine for growth. You know, those 18,000 ounces at a project level produced EBITDA of $20 million, which resulted in operating cash flow, which is after all the corporate overhead and everything's taken care of $14 million. And we can take that and really put it into growth programs like Goldboro, like Tilt Cove. This year, we're on track to do 16,000 to 17,000 ounces of gold. Operating cash costs in US dollars for the rest of the year would be around $1,150. And all-in sustaining cash costs around $1,400 US. So notwithstanding some gold price volatility of late, we still have good margins on those ounces that we're producing. Now, the question with Point Rousse is always life of mine. You know, we've had 2 years of life of mine for the last 5 years, but we've had some recent success in this area. And I'll let Kevin touch upon that as we start to get more visibility out in terms of our mine life.
Excellent. Thank you, Rob. The mill and tailings facility is down here in the southwest of this map. We're currently mining at Argyle in the northeast of the scrape trend, and we have a new discovery about 3 kilometers away from the mill called Stoggertite, which is now in the process of starting to permit to come on as our next mine after Argyle. The discovery of Stoggertite is a little different geology and a little different target than we're used to for the last 10 years, and it's opened up several other new targets that you see highlighted on this map, 6 or 7 of them that we'll be drilling with some of the money that we raised as well to continue adding to the mine life. Our original holes at Stoggertite, the discovery, were fantastic. They did happen to be our best holes, and this is turning into more like your normal, what we've been mining over the last 10 years, possibly a little higher, 2 to 3 grams per ton. And we are doing wireframes now and mine plans based on the drilling to date, and we're pretty sure that this will be our next mine, so much so that we've started the permitting process. And that's all to keep us going until we find something higher grade to put through our current mill. We're searching around a past producing mine called Nugget Pine that produced at close to 10 grams per ton diluted grade. As Rob said earlier, $14 million cash flow from approximately 1.6 grams per ton. Imagine putting somewhere between 5 and 10 grams through, like the Nugget Pond, through the same mill. It would be a step change for us. So we're quite happy to have lined up 13 plus targets that are similar in geochemistry, geophysics, and structure to Nugget Pond along strike. You can see the anomalies, which are similar to the anomalies where Nugget Pond was, and we'll be knocking those off one by one. With a lot of information and news flow coming out with some of the money raised as well. So all that said, we're a lot of cash on hand, over $20 million, including the funds raised in May. We have a preliminary economic assessment that's just been delivered showing the value of Goldboro over time. Lots of drilling targets, ongoing drill results, feasibility coming at the end of the year, and numerous development milestones to become plus 100,000 ounce a year producer. So we'll leave it at that and hand it back over to Deb.
Thank you. So I do have a number of questions that were sent in advance, as well as some that have been inputted. Some of them you covered, so I'm going to skip over them. But here's one. So what is the production timeline for Goldboro, assuming you get your definitive feasibility out at the end of this year? Can you kind of walk us through that? Kevin, you're on mute again.
I had a really good answer. So we have spent a lot of time in getting our environmental up to speed and getting our feasibility done. And what's required for the environmental assessment registration document is where the infrastructure is going to be exactly, and that has to be nailed down with the feasibility. the exact chemical composition of discharges into the environment, being tailings, waste, other things. All that will come out of the feasibility. It'll then take 4 to 6 weeks to complete the report with that information in a fashion that's set, that you have to adhere to for submitting these EARDs. And the process itself has up to 4 review periods, whereby it's 60 days of review and 60 days of responding to questions. And you can have up to 4 of those if you haven't answered questions sufficiently. So we want to have as a robust a document as we can first. And, we know that we'll have a first set of questions because people have to ask questions, or why are they there? And hopefully we don't have 4. But with all the review periods necessary, that's an 18-month process. With no questions, it's 6. So we're guiding 18 as if we're going to have all 4 sets, which we may, but we hope to do better than that. So that would mean that we're submitting our EARD somewhere in February of next year. And then it's 18 months from there that we'd be able to start digging. So, just after mid-2023, which would make it the next mine in Nova Scotia.
Okay, and since you're on the topic, can you address the various approvals, federal, provincial, First Nations, that are required before commercial production, especially with the open pit? Can you just kind of walk us through what that regulatory framework involves?
Yeah, so for the open pit, again, we have to go through the EARD process and then get an EA, an EA, which is your permit to build and produce based on certain regulations or decrees. We have to have all documents in Nova Scotia, which is different than in the rest of Canada. There has to be consultation with the Mi'kmaq, only one native group, the Mi'kmaq, who in Nova Scotia did not sign a treaty with Canada and therefore act differently, and there has to be consultation with them. But we have a very good relationship with the Mi'kmaq. We have a memorandum of understanding already signed to work towards a mutual benefits agreement. And quite honestly, they're not asking for a lot. They're asking for the opportunity to be trained, to apply for jobs, as opposed to giving us quotas, things like that. So they're very good. We've also got a signed benefits agreement with the community of Guysborough, which is where Goldboro is located. They're reaching out to us now, asking how they can help speed things up to get permitting and create jobs. Locals are on board. So we really need the EARD to be accepted, and then really everything else rolls in place, like the civil works permit and all that would be standard after that. It's really the environmental permit that's required. And that in Nova Scotia, so federally, the rules have changed. If you're 5,000 tons a day or over, it's a federal permit. If you're under that, it's provincial. So we are doing the provincial route. It's not a federal permit. However, we're having to do a alternatives assessment, which is a federal thing about waters frequented by fish. So we have to show our infrastructure in various locations of what's net benefit for technical, economic, and environmental. So we've positioned our infrastructure in 14 different ways, like a puzzle. And what we showed earlier in our slide is what we ended up with. And fortunately, we were able to fit it all in one watershed, which is very important to us.
Okay. And since you're on the topic, can you elaborate a little bit more on what environmental programs, ESG type stuff, and what your relationship with the First Nations or the community in the area is like?
Yeah, well, we have a community liaison committee that meets on a regular basis, usually monthly, sometimes more, which has people from the Mi'kmaq, from local community, and from government on it, as well as people from our company to discuss the project as it moves forward. Again, we have a very good relationship with the Mi'kmaq. I personally talked to the chiefs, Chief Terry, and other chiefs within the Mi'kmaq. Great relationship. They're very, very advanced there. They own fishing companies and packaging companies and get involved in actual business there. Very business oriented. So if that's going very, very well, the community is going very well. looking for work. So, I think that we've really got a good handle on moving forward. It's a very industrial area with low employment. There really is. I mentioned a buried natural gas pipeline going west of our pit. I mean, there's a natural gas transfer station there. It really is an area that needs to create some employment. We're going to create 150 jobs up front and 300 when we get full scale with underground and open pit. And the spin-off jobs in the mining industry are usually 6 to 7 to 1. So we'll create another, 2,000 jobs that are spin-offs from direct employment. So it'll really enhance the area.
And I'm assuming there is skilled labor in that pool of labor, or will you be training?
There's some skilled labor, but we're going to have a camp for 150 men because there isn't enough places for people to stay, and B, we're going to have to do contract mining. A company our size can't go in and expect to have their first mine done while you're training people. So we're going to have trained people that will over time switch over to owner operated is the plan going forward. And actually we have put a lot of money into community. We're talking about training programs, talking to bringing students, keeping students in by telling them the benefits of mining and training them. We'll have a training program with Mi'kmaq as well that we help sponsor. We've been giving back to the community. Any areas that we disturb, we'll be compensating. I think it's on a 3 to 6 to 1 scale of opening other wetlands elsewhere. So we really have a comprehensive ESG program going, and we'll be able to get better at that as we start mining and generate revenue.
Okay, great. And I had one last question on Goldboro and the PEA. It came in before the session. You did cover it, but I thought it would be worth highlighting again. So in the recent PEA, you have initial capital cost of $286 million, resulting in an after-tax NPV of 5% to capex ratio of 1 to 9, or no,
1.9 to 1.
Sorry, 1.9 to 1. So this is just going back to the strategy that you had in terms of developing the open pit versus the underground. Can you walk through that strategy one more time for us?
Yeah, sure. We originally bought this project when it had 850,000 ounces and was considered a higher grade underground mine. And we kept drilling. There were 23 or 24 stacked lenses when we bought this. We were able to get through 60 of those now. But more importantly, in between those lenses, we noticed that the background, which hadn't been sampled in the past, but the background between is actually mineralized as well at average values between 0.5 and 1 gram per ton. So they were being missed looking at it underground, because underground you need a 2 or 3 gram cutoff. So they were being discarded as waste. But when you look at it from an open pit point of view and a cutoff of 0.45 grams per ton, that's all ore. And that's what's made this a large project. So it's turned into a large open pit. Now for permitting, for a PEA, the 43-101 regulations suggest that you have to show what measured and indicated can do, and also inferred over time should it be converted. So, that shows us converting some of the inferred resources underground for the PEA to transpire as the way we've shown it. We've also included in the all-in sustaining costs $30 million of conversion drilling. A lot of juniors will just leave that out and assume the conversion happens magically. We've paid for it in our PEA. It doesn't mean it's going to happen. That's why they're still inferred. They need closer, tighter spaced drilling. So we know that we have over a 10-year mine life for open pitting. It justifies and warrants doing a feasibility and starting to mine and create cash flow while we drill expensive deep holes to convert the inferred at depth, to eventually do phase 2 feasibility, which incorporates what will be measured and indicated underground after drilling. So, we're a company that doesn't want to delay a couple of years and drill off the underground inferred at literally tens of millions of dollars to convert when we already have a 10-year mine life, and we can get going and create cash flow to really drill it off quicker and get it into production. So the actual initial CapEx covers everything that would be required whether we go underground or not, because the underground are going in from the pits. So it's just really an enlargement of the tailings pond for some more tons of ore, but not much more tons of waste, because obviously you're not stripping when you're underground. So it allows us to drive ramps from lower down in the pit, which is much cheaper. It allows us time to drill off, and it allows us the benefit of moving forward and developing something that creates significant cash flow instead of the other way around, spending and diluting shareholders to try and drill off something at depth.
Makes sense. I think we're seeing a lot of companies do the staged approach as well. So just moving on to Newfoundland, I had one question about Point Rousse, at least I assume it was, which is, what's your best guess as to when the higher grade ore will actually start being processed there?
Well, that's a process that takes time. We're on a belt that shows previous high grade hits and a previous high grade mine, and we're searching for other deposits that are similar to that. So to know what the time frame would be you'd have to be a magician. It can be very quick from the first time you tap into something to drill it off and permit it and move it to our site. But we have to discover it first, and that could be tomorrow or a year and a half from now. It depends on which of the 13 plus targets is going to turn out and how well we do our targeting and our drilling. So we're quite confident with our exploration team that they will make a discovery if there's one there. And we are in a very prime belt because of the past production and some of the historic results. We're pretty happy and excited about the potential there, but it is greenfields, it is grassroots exploration on a belt that has historic production and height.
Can I just add on to that? Because there may have been, and I'm not sure the context of the question, in case there was reference to our current production profile, because we had pretty low grade during the beginning of the year. Looking out for the rest of this year, we do see grade popping up in Q3 and Q4 from Argyle. Because I know we had some. So Q2 will be certainly better gold production, and we're right on our plan for our current guidance. Grade will still be low, but that's as we expected it because it's lower in the upper parts of the bench, and we do supplement with low grade stockpile. But as that ore starts to open up, which is actually actively happening as we speak, Q3 and Q4, and actually going even into Q1, Q2 of next year, we'll start to see the grades that are more typical of Argyle based on our geological model.
Rob, can you remind me what you're guiding towards for production this year?
16 to 17,000 ounces. So we had a tough start in Q1, and we did revise that downward based on the new plan that took into account some of the learnings, if you will, from that first quarter. And like I said, we'll have our Q2 results out in the next week, and we'll demonstrate that we continue to be on plan for that revised 16 to 17,000 ounces.
And there's so much activity in Newfoundland right now. How are you finding it in terms of labor, drill rigs? Are you finding challenges?
Yeah, we are. Obviously with that much money going into a small province that quickly, supply and demand happens, and everybody is looking for drills and drillers and geologists, and that creates a lot of competition. So we feel that we treat our employees better than most with all the benefits that we have, and our longevity in Newfoundland is a thing that people like as well. So there is a lot of competition out there, and you can't you can't just order 5 new drills quickly. You've got people who are putting in tens of millions of dollars into drill programs, and there's competition for drilling, which also fills up the labs, and then there's delays in returns of assays. So we are experiencing it, but it's not a material difference to us at the moment. We do have preferential treatment at one of the labs because we're a good customer over the years. So we've been able to manage it. We've even been able to manage it through COVID, where certain employees have just accepted to stay away from home in a different province for quite a long time, because they just they actually really enjoy what they're doing and they want to see the company advance. So we've been very, very fortunate throughout.
Well, that's good. As someone that used to work for you, I'm glad to hear you finally started treating your employees nicely.
It started when you left.
I figured. No, that's great. Yeah, Newfoundland seems like a really exciting area. You've like looking at your overall portfolio, what are your long-term plans for the assets you have there? I know you divested some projects, I think it was two years ago, to Magneterra. What are your plans in terms of M&A?
Yeah, it really didn't. The divestiture of projects to Magneterra wasn't really a Newfoundland thing. It was actually a grassroots thing. So there was also New Brunswick in there as well. So, we wanted to focus on brownfields. We wanted to focus in areas, either brownfields or where we were close to a mill and a truckable distance, to grow as a gold producer, as opposed to an explorer, so a developer and a producer. So we are the largest shareholder of Magneterra. So we still have shareholders still have a name in that game. But we've always wanted to be an acquirer rather than an acquiree. So as we leverage through it and meet the hurdles of bringing Goldboro forward and get true value in our stock, we can use that as leverage and look for an M&A transaction as part of our growth strategy. But obviously, we wouldn't do that before building Goldboro because we'll be very, very focused.
Okay. And then I don't see any more audience questions. So I'm going to get you to do a little bit of a summary for us because I believe you have 4 drill programs going right now. Maybe you could walk us through some of the coming catalysts that investors can expect in the second half of the year.
Sure. First of all, we'll start at Point Roos. We're finalizing drilling and planning at Stoggertite, which should be the next mine after Argyle, as well as permitting. So we'll see drill results coming out of Stoggertite and eventually a mine plan out of that over the next few months. Based on that discovery, as I said earlier, we'll be drilling other targets that are similar in nature to Stoggertite, which is a little different than what we're used to over the last 10 years. So it's opened up opportunity on other low-order IP anomalies without a large surface expression. Public Point and Corkscrew and Animal Hill and all other kinds of funny names are targets that we'll be testing with the drill bit over the next several months. So there'll be a constant news flow in and around Point Roos from drilling. We are going to do a couple of months of target generation beyond the targets we already have at Tilt Cove, and then we'll be drilling in the fall into the winter at Tilt Cove. It's much easier during that time to drill there. As far as Goldboro goes, we are going to spend $4.5 million on an exploration program west of the current resources on the western half of our project, which will involve detailed geophysics and drilling of those targets that are generated through geophysics, and that will start as soon as we get permits to do so. So we've sent a request for permits to do line cutting on geophysics to pinpoint where we want to drill, and also and then we'll put in permits for drilling. So I don't expect we'll get those permits for geophysics for another 4 to 6 weeks, at which time we can do the geophysical program. And that means we wouldn't be drilling there west of Goldboro till the fall. But that's not that bad because we're using all the drills to do the final work that's required for the feasibility study, geotechnical drilling, well holes, water wells, with the drills right now at Goldboro, all pertaining to giving information to finalize the feasibility study.
And which lab are you sending the assays to?
Eastern Laboratories.
Is that in the East Coast?
Yes, that's in Newfoundland.
Okay, that's the only lab on the island, correct?
I am unaware of any other, but I don't know if it's the only one.
Have you found the turnaround times are slow or slower?
Well, they're slower than they would be in the past over the since all this money has been invested into Newfoundland. But for us, we are able to get them fast tracked, which means we're getting results like we would in the past, even though it's fast tracked. But it's in a reasonable time, 3 or 4 weeks.
Mm-hmm. And you mentioned no surface expression, or I understand that in Newfoundland there's a lot of overburden. Does this mean you spend a lot more time doing baseline work before drilling, or how do you deal with that?
Yeah, I mean, geophysics is very, very productive for us in the Baie Peninsula. All deposits to date, however, in Newfoundland have been discovered with geochemistry. So this new deposit I'm talking about is actually a flatline deposit, not far under surface, but because it's not a vertical deposit, it doesn't surface, it's subsurface. So you get a very weak geochemical signature on surface, but a corresponding IP anomaly showing chargeability or mineralization of some sort. And that usually gold is associated with some form of mineralization besides gold, like pyrites or pyritites or arsenopyrite a lot of times. So that pinpoints your targets for mineralization with a slight gold anomaly on surface. And that's opened up a lot of areas for us in the Baie Peninsula that could potentially be other rolling or flat-lying deposits that are not coming right to surface. Okay. We've actually had, we announced it a week or two ago that we had an intersection at Pumley Point, which is a new area. I think it was 5 meters at 5 grams. So that's a new discovery that needs to be followed up on. And, these things can get, that would be a normal drill hole in one of our deposits.
Great. Well, I don't see any other questions. Is there anything that we didn't cover today that you wanted to talk about, Kevin or Rob?
I think we got it all as far as I can see. Rob, or have we got everything out there?
I think so.
Oh, I see one question. Oh, this is a good question, actually. How, if any, is they're asking about, sorry, the question is worded strangely. The renewed attention that Eric Sprott's getting in Newfoundland with the investments that he's making, are you seeing like an increase in interest in the area, or has it been pretty hot for the last year and a half?
I think it was, it was getting hot with a lot of investment coming into Newfoundland, and when Eric invested in a few companies, I would say that got more eyes on it and just created a snowball effect. But it certainly was picking up before that.
It's crazy. There's so many new companies coming out of nowhere. Like I couldn't even name all the Newfoundland players. And as you know, we did that conference in April and we looked at, oh no, it was in February, and we looked at all the ones that we could find. And I would say that there's at least 20 more companies that have picked up assets in the area.
Yeah, it's the nature of our business is such that, if there's ground available around a discovery, it makes sense to see if you can go and test your luck and get into a bull market. But sometimes those don't last through waves of markets. We've been there 10 years. We've got the only infrastructure. We find that we recognize potential there a long time ago, and we've been successful with it on a small scale, and that's allowed us to now have leverage over others coming in, like quick turnarounds at labs and people that have been with us a while that'll stay with us a while. So I think it helps us a bit, but there's certainly a lot of attention on the East Coast at the moment.
Can you still stake ground from the government, or has it all been staked? Like, how does that work? Is it only an M&A market right now, I guess is the question?
Well, I think what you'll find is anywhere in Canada, not unlike Newfoundland, is that a lot of these concessions that are on areas people would want to be are held by currently now companies, but say a year ago by individual prospectors that are just looking to, have someone come in and do a transaction that will benefit them over time. So I think there's a lot of time good quality ground is not available for staking, but you can go in and stake ground if it's open. But it's hard to find ground that's open that isn't, that has a lot of potential.
Got it. All right. Well, I don't see any other questions. Thanks so much for the update. Congratulations on the PEA. It's very impressive numbers. And Kevin, I think was it 2 years ago that you joined Anaconda, or has it been 3 now?
It's been 2 and a bit.
2 and a bit. And I remember you saying that you're going to build it into 130 to 150,000 ounce producer. And 2 years ago, I think everyone thought you were crazy, but you're getting very close to being able to execute on that. So congratulations.
I've also gotten crazier.
And yeah, thanks for taking the time to answer some questions today. And I look forward to seeing some of the news flow over the summer and the fall.
Thanks very much. Really appreciate the opportunity to give people an update.